My name is Jeff from Edge Network. Welcome to our FAC session. So we're going to continue with our financial instruments, IAS 32. So the previous video that I had covered was just the definition and the brief explanation on what financial asset is. So now I'm going to cover the financial liability. So let's get into it. So a financial liability, which is the other side of an asset, right, is any liability that is a contractual obligation. So it's based on a contract, right? So remember, when it comes to a contract, it can be verbal, right? We can agree, yes, you give me this much, and I'll give you this, right? Can I have your car? I want to buy your car, so I'll give you your money next week or whatever. So it's a contractual. So contractual can be verbally, or it can be the normal way, which is your document, right? Where you both agree by signing, right? It's an contractual obligation. Remember, obligation is a responsibility. It's a duty, all right? Obligation, responsibility, duty to deliver cash or another financial asset, or to exchange financial assets or liabilities under potentially unfavorable conditions. All right. So that is the definition of a financial liability. Okay, so let's go to the example from where we shall then explain in more detail about a financial liability. So based on our transaction one, Global purchased 100,000 ordinary shares, right, in Excel. All right. These were acquired at fair value on transaction date. Right. So with this kind of a setup, right, we have got Global, right, that is buying shares from Excel. Okay. So then now when you then analyze this line or this scenario, right, you will find out that there is no contractual obligation to deliver, right, cash. There is no contractual obligation. So I will explain what transaction one is, right? So let's go to transaction two. Transaction two says, 1 December 2013, Global obtained a short-term loan, of 20,000 from Excel and is required to repay the total loan within 90 days. The loan is still outstanding on 31 December 2013. We have a situation where Global went to Excel to borrow 20,000. And Excel had the funds and managed to give Global the 20,000. But there was a time frame of 90 days. As you can see here, one of the parties has a contractual obligation to deliver cash within 90 days. In this case, Excel gave out the money to Global. Global received the money. So Global is supposed to return the money within 90 days. So therefore, Global is the one that has a contractual obligation to deliver the cash. Let me demonstrate via an example on the whiteboard. So using the names from the example, this will be your Excel, and this will be a Global. Okay, so Excel gave out how much? 20,000. And Global is supposed to return the money within 90 days. So that means that there was a contract. We don't know whether it was verbal, but we assume it was a document. So they both signed, both parties signed to say, I'm giving you this money, please give me my money within 90 days. But it's unfortunate that the scenario told us that Global has not yet paid within 90 days. It happens. We all do that at times. Okay, where there's a deadline, but we can't pay. But that does not take away the fact that you've got a contractual obligation. You have a duty to fulfill, which is to pay someone back. Pay back what is due to the other party. So because of this, Global will need to recognize a financial liability. Right. The reason being there is a contractual obligation. Okay? To do what? To deliver. Deliver cash. Okay? And that cash will be the what? The loan. Okay? Of 20,000. So this is now, remember, in the records of this one. The first video that I covered was when Excel, right, is recognizing a financial asset. Okay, based on the reasons that I gave you. So this one is focusing on financial liability. Liability is debt, okay, which has a credit balance, okay? If you're doing accounting, credit balance. So please remember that there should be a contractual obligation to deliver cash. All right. Then the other side also that covers, right, that fulfills the definition of a liability is when you are paying using your own shares. So let's get into that one. So if you remember, we said contractual obligation to deliver cash or another financial asset, okay? Or to exchange financial assets or liabilities potentially unfavorable condition, under potentially unfavorable condition. So let's cover the other part of that definition. We've covered the cash. Right. If you go to transaction 3, it says on 1 December 2013, Global obtained a short-term loan of 20,000 from Excel and is required to cycle the total loan within 90 days in as many shares as equal to 20,000. The loan is still outstanding, so it's similar to your transaction 2, just that with this one, you are supposed to pay using cash. This one, you are going to use shares to cover 20,000. So the downside of covering this using shares is that, remember, the share value changes from time to time. So by the time you want to pay, right? By the time you want to pay, you find that the share price has changed. So that will actually end up disadvantaging you, all right? Because maybe you need to issue out more shares in order to equal the 20,000. You understand? So this is the other situation that will result in a financial liability, even though you are paying back using shares. It will still amount to a financial liability. Are we together there? Right. So let me be quick in reading this part on the notes. It says, please note a contract to deliver as many of the entities on equity instrument as are equal in value to the value of 100 ounce of gold. right? As an example. So in that example, it's you're trying to match 20,000 rands, right? Such a contract is a financial liability and not equity of the entity, even though the entity must or can, right, cycle it by delivering its own equity instrument. It is not an equity instrument because the entity uses a variable number of its own equity instrument as a means to settle the contract. Accordingly, the contract does not evidence a residual interest in the entity's assets after deducting all of its liabilities. All right. So this will help you to understand if a company is owing another company, right, and they cannot repay, right, as per the agreement in the form of the cash that they had taken initially, but they are going to pay using something else, normally using shares. It's like an individual that cannot pay back the money, but you are going to pay using maybe property or using livestock. So that means for you to match that, it's either you find yourself losing out because in order to match that amount, that means there is something that is of importance to you that you need to what? Let go in order to cover that amount, right? So it will still amount to a liability, right? But sticking to the shares, right? If you're going to come across such a scenario, please make sure that you don't identify that as an equity instrument, but it will be identified as a financial liability. So remember, the scenario is the same as in transaction two, just that here you're going to pay back using shares. And I'm going to remind you again, it will be a financial liability. Okay? Because you are using, the main word there is you are using a variable number. It is not a fixed number. It's a variable, so it's going to vary because you'll find that, okay, maybe initially when you got that 20,000, right, maybe the number of shares that were equal to 20,000 maybe was 1,000 shares. All right, was 1,000 shares could cover that one. But now later on, when you now want to repay this, the number of shares that you need to pay back is maybe 1.5. You understand? So you are losing out ownership. Remember, the more shares you issue, you are losing out on what? On the shares, right? On the ownership grip on your on the company, because 5,000 is going to that person. So the 500 is going to that other company as a form of what? Of a repayment. So there is diluting of your shares. So that's why they said that is potentially unfavorable for you, but you need to pay your debts. Okay, so that is a financial liability. So until next time, have a good day. We shall meet in the next coming videos.